Well, it's a chart that's flashing a yellow caution sign for the U.S. equity market. Fewer stocks backing the strength that we've seen in equities. Our next guest says investors need to tread carefully. Joining us from New York, J.C. Peretz, founder of allstarcharts.com. Thanks so much for joining us, J.C. We're talking bad breath.
Yeah, that's right. We've been pounding the table bullish, for well over a year now. I've been, one of the more vocal bulls on the street, particularly on this network. And our target the entire time, especially since last summer, was about 23.40, 23.35. And that target was hit a month ago. So from a pure price perspective, our upside objectives have been met, which is great, right? Stay disciplined, take profits. But in addition to that, on the more recent highs in the market, and I don't just mean the S&P 500, but even more broadly speaking, the S&P 1500, the Russell 3000, the real representation of the stock market, we're seeing much fewer names in those indexes participating with upside bullish momentum. And when you're seeing that divergence, it's kind of a heads up that momentum is waning, breadth is weakening. We've seen that at prior tops more recently in 2007 and 2011. So, it doesn't mean we need to crash from here, but targets achieved, momentum waning, just back off, I think.
So then what do you look for in terms of a turn in that indicator? And to your point, when you are seeing that declining group of leadership, what's falling by the wayside and what's still holding things up right now?
Sure, it's the largest names, right? So the whole point of breadth weakening is basically just representing the fact that fewer and fewer names in the stock market are participating to the upside, right? So it's just fewer and fewer names, the super mega cap names, the Amazons and the Apples of the world and Microsoft, right? Big names. So what do we want to see? Well, at this point, the market can correct in one of two ways, either through time or through a downside price correction. And, my crystal ball's in the shop right now, so I can't tell you which one it's going to be. But as time goes on, the next several weeks, the next several months, if we start to see an expansion of participation with upside, a strong momentum, if we start to see that expand, I would argue that's a positive catalyst that should lead to a new leg higher. But at this point, we don't have that information. So I'm in a wait and see mode in terms of the stock market for sure.
And are financials a big part of that? Because certainly they've been the weakest part of the market since the all-time high on March 1st.
Yeah, I think you nailed it right on the head. I think that's the problem, right? We want to see the financials leading the market higher, right? It's arguably the most important sector in the world. So coming off the July lows last summer, well before any election, U.S. or otherwise, financials had already bottomed. Interest rates had already bottomed and ripped into the end of the year and early this year. So moving forward, what do we want to see? We want to see financials starting to participate. We want to see interest rates breaking out to the upside. Unfortunately, the weight of the evidence is suggesting the opposite. Further weakness from financials, lower interest rates, a dead market at best. So I think you get out of the stock market for now with any sort of intermediate term time horizon, and I think you got to err on the long side of bonds.
Even bonds, that's pretty interesting, which has already been, they were a winner in the first quarter. What makes you confident in your call on bonds?
Well, I don't necessarily think that bonds have been a winner in the first quarter. They really haven't done anything. But I do think that if the U.S. 10-year breaks 2.3%, which is the major line in the sand over the last couple of months, if that breaks to the downside, you're going to get a major squeeze in bonds. Financials are going to come off. And that money that's been flowing out of the market and into the stock market since last summer, I think will change temporarily. And that money coming out of stocks will go into bonds. So that's how I see it. 2.3% is the line in the sand. If we hold above that, I think that would be good for the stock market. I think that would be good for financials. I think that would be bad for bonds. But if we're below 2.3 in tens, I think you stay out of the stock market and you err on the long side of bonds, for sure.
Before you go, I got to ask you about the Nasdaq, which hit an intraday high yesterday. Does your cautious view on equities extend to the Nasdaq as well? Are you seeing what you're seeing in the S&P 1500, declining leadership, fewer and fewer stocks participating in the rally?
Yep, we're seeing the exact same thing. You mentioned the Nasdaq hitting a new high intraday. Perhaps the cap-weighted Nasdaq 100, but if you look at the equally weighted Nasdaq 100, which doesn't skew the larger cap names with a higher representation in the index, but every single component has equal representation, momentum is diverging big time. Breadth is diverging big time in that equally weighted index. So while a cap-weighted index might be making new highs, the broader market, particularly in this index as well, is suggesting otherwise.
JC, thanks so much for joining us.
Thanks for having me.
JC Peretz, the founder of allstarcharts.com. Well,